Why is PayPal falling if the numbers are not terrible? PayPal looks cheap, but cheap stocks can stay cheap for a reason. Today we are looking at PayPal, ticker PYPL, and the real question is simple. Is this finally a real value opportunity, or is the market right to treat it like a broken payment story? By the end of this video, you will know the fair value range I'm watching, the margin risk that could break the thesis, and what would make PayPal more than a cheap-looking stock. For me, 3 numbers decide this setup: revenue growth, margin pressure, and free cash flow. If those 3 do not line up, the low valuation does not matter. The short version is cheap looking, not automatically cheap. Keep that line in mind, because it is the difference between a value opportunity and a value trap. So, what are we going to find out? This is not financial advice. I'm going to walk through what PayPal does, what happened in the last quarter, what the price chart is telling us, how the finance to go scorecard looks, what the valuation could be, and then the bull case, bear case, risks, valuation, and my final verdict. The reason PayPal matters right now is that the stock is priced like the market has almost given up, while the company is still producing real cash flow. If you're building a watch list instead of chasing headlines, this is what I would do. If you want stock breakdowns that separate cheap from actually undervalued, subscribe to Finance to Go. The goal on this channel is to separate real opportunities from value traps using numbers, valuation, and plain English stock analysis, you could say. So, what kind of business is PayPal today? PayPal is not a fast growth story anymore. I would think of it more like a mature payments company trying to prove the turnaround is real. The attraction is cash flow and scale. The problem is that scale only matters if PayPal can defend its checkout position and stop the margin pressure from getting worse. Here's the simple version. PayPal still has a recognizable brand, a huge merchant network, and a business that can produce a lot of cash. That is why the stock is interesting at a low valuation, but it is not the kind of company where I can just say, great brand, low multiple, done. The moat has to be tested. Branded checkout has to matter. Management has to prove the business can stabilize. I like the cash generation, but I do not want to ignore the moat question. If PayPal is still a durable payments platform, the stock could be too pessimistic. If competition keeps eating away at its position, then the low valuation may be a warning sign. That is the balance I want to keep you in mind before we get to the numbers. So, what is the market already telling us? The main thing I want you to notice on this chart is the market reaction. PayPal is trading around the mid-40s, so the market is clearly not pricing this like a clean compounder. That can be a useful starting point because the stock does not need perfection to become interesting, but it does need evidence that the business is stabilizing. A low price only helps if the cash flow, margins, and competitive position can support the value case. So, did PayPal actually beat expectations? The last quarter is where the story becomes mixed. In Q1 2026, revenue was $8.35 billion, ahead of the $8.11 billion expectation, and revenue grew 7% year over year. Non-GAAP EPS came in at $1.34, non-GAAP EPS versus $1.27 expected. Those are green signals, and they are why the quarter cannot be dismissed this week. The margin side is the red flag. GAAP operating margin was 17.8%, down 182 basis points. and non-GAAP operating margin was 18.4%, down 229 basis points. This is why the quarter is mixed rather than simply good or bad. Revenue and EPS beat expectations. Adjusted free cash flow was 1.72 billion adjusted free cash flow. 20.6% margin and buybacks were 1.5 billion. They repurchased roughly 34 million shares. That gives me enough cash flow support to keep PayPal on the research list, but margin pressure still needs to improve before the turnaround feels proven. If I wouldn't hold this sort of objective stock review as sort of like a PayPal fan or a PayPal believer that believes in the turnaround, this would be a great opportunity, but we want to keep this a bit more neutral and objective as per our stock analysis standards. So, what improved and what still looks weak? This is where the story gets more interesting, because an earnings beat is not always a clean quarter. What improved was revenue, EPS, free cash flow, and buybacks. More specifically, revenue beat expectations and still grew 7% over year. Non-GAAP EPS beat expectations, showing earnings power is still present. Adjusted free cash flow remains strong enough to support buybacks. Buybacks were meaningful at this low valuation, which can support per share value if the business stabilizes. What got worse was the margin picture and the confidence around PayPal's long-term checkout position. More specifically, GAAP operating margin fell 182 basis points. The bulls are right that PayPal is cheap on cash flow, but they may be ignoring how much margin pressure can offset that valuation appeal. The bears are right about competition, but they may be missing on the bigger picture in this case. So, and also the free cash flow and buybacks that can naturally pretty much buy back the entire company long-term wise. So if the business stabilizes, this is a huge thing as well. So I do not want to summarize this as simply a good quarter or a bad quarter. Cash flow, EPS, and buyback support the value case. Margins, competition, and market confidence are still the parts that need the proof. So where does PayPal score well and where does it fail the test? In my case, this scorecard is useful because it stops us from making one of the biggest mistakes in value investing, calling something cheap before checking whether the business deserves the discount. Here's the read on PayPal. So my personal growth score is 5 out of 10. Maybe I need to actually tweak this to the lower end in the future because revenue is still growing, but this is no longer a high growth story. Profitability score is 6 out of 10 because PayPal remains profitable, but operating margin moved in the wrong direction. And the cash flow score is 8 out of 10 because free cash flow is the strongest part of the thesis. And yeah, balance sheet for me personally is 7 out of 10. I need to update this. This is not true. Because liquidity appears solid enough to support the turnaround and buyback story. The valuation score for me is an 8 out of 10 because the multiple looks lower if cash flow holds. But the discount may be deserved if execution disappoints. Shareholder friendliness score is 7 out of 10 because buybacks are meaningful, especially if done at attractive prices. The risk score for me is 5 out of 10 because competition, margin compression, and execution risk keep the story from being clean. The momentum score is 5 out of 10 because the quarter beat expectations, but margins and market reaction are very mixed, if not super negative. What is PayPal worth if cash flow holds? For valuation, I do not want to rely on just one method. PayPal is mature and cash generative, so free cash flow should be the anchor. Earnings are useful as cross-check, and owner earnings help us think about what cash the business can actually produce for shareholders. For this analysis, the fair value range is $54 to $68, and the buy zone discussion starts below roughly $48, assuming free cash flow stays durable. The valuation methods behind that are free cash flow multiple, most important method because PayPal is mature and cash generative. Earnings multiple cross-check, useful because non-GAAP EPS remains positive, but it should not ignore margin pressure. Own earnings, that range, treat operating cash flow minus reinvestment needs as the anchor, and use range instead of fake precision, you could say. The key point is that this is range-based, not fake precision. If margin keeps moving lower, the fair value range should come down. If free cash flow stays durable and the company improves execution, the current valuation may be too pessimistic. So the story is not just whether PayPal is cheap, the story is whether PayPal is cheap enough for the execution risk investors are taking. So for me personally, as a very fond person of the PayPal business, because as I said before, I'm a believer, I'm a fan almost. This is a very clear buy, very clear buy zone area, you could say. So for me, I even buy into this range. I would even buy the business as like $65, $68. But that doesn't need to be the case for you. According to my valuation range in this case, I think a pretty good buy zone is below the $48 mark. So what has to go right for the stock to work? The bull case is that PayPal is still a large, profitable payments platform with real cash flow and a low valuation. The company does not need to become a hypergrowth stock again. It needs to stabilize brand at checkout, protect margins, keep generating cash, and use buybacks intelligently. Next, PayPal remains a large two-sided payments network with strong brand recognition. Strong free cash flow can fund buybacks and support per share value. If brand checkout stabilizes and margins improve, the current valuation may be too pessimistic. If that happens, the market may eventually decide that the stock was priced too pessimistically. The buyback angle matters here because reducing the share count at a low valuation can create per share value even if the business only grows modestly. So to sum this up pretty fairly, if they buy back 50% of the company and it turns out that PayPal now is this fancy new great company because PayPal Ads is doing great, it's finally launched and doing great, and all the other things they want to change is paying off as well, then them having done so much effort in the buyback area would pay off greatly, because now if you bought back like half the company, it's so much easier to push the share price. But that's all under the mentioning of PayPal really stabilizing. So yeah, what could make PayPal a value trap? The bear case is that PayPal is cheap for a reason. A low multiple can be a bargain, but it can also be a value trap if the business keeps losing relevance or if margin pressure continues. The main risks I'm watching are competition risk, margin pressure, execution risk, looking at you, Enrico Lores, potential value trap risk if free cash flow weakens, and the bear case points are competition from Apple Pay, card networks, banks, fintech apps, and checkout alternatives can pressure growth and margins. Margin contraction can offset revenue growth and make the low multiple deserved. Buybacks do not fix the thesis if the core checkout position weakens. For me, the biggest risk is that revenue growth does not translate into better earnings quality. If PayPal has to spend more just to defend its position, then the free cash flow story becomes less attractive over time. What would change the thesis next quarter? What to watch next quarter is where this analysis becomes practical. I would focus less on one headline, EPS number, and more on whether the pieces of the thesis are actually moving in the right direction. The main items are branded checkout growth, transaction margin dollars, GAAP and non-GAAP operating margin direction, adjusted free cash flow durability, share count reduction from buybacks, updated guidance, and management tone. My next quarter scoreboard is basically branded checkout growth, transaction margin dollars, and all those things. If all those basically keep falling for another quarter, that would be a very bad sign. At least in the quarter-to-quarter view. In the year-to-year view, that's probably already going to be the case. Adjusted free cash flow, if that were to weaken instead of staying durable, and branded checkout trends fail to stabilize, buybacks stop reducing share count in a meaningful way, that will all be things that would be a huge red flag for me. So is PayPal a buy zone candidate or a trap? My Finance to Go verdict is that it's worth researching, worth a value setup, so it should go in your research list. But it's not a clean automatic buy for everyone. For me it is, because as I told you before, I'm a PayPal fan. I love the product, but that's something personal. It's not the general opinion, and it shouldn't be, because according to this data, the positives are obvious. There's this valuation, the free cash flow, the buybacks, but the negatives are also obvious. Margin pressure, competition, and the need to prove that branded checkout can remain relevant. The title promise was cheap opportunity or value trap, and the answer is cheap looking, not automatically cheap. The reusable lesson is that revenue can beat expectations while margins still weaken, so an earnings beat is not automatically a clean quarter. I see this as a value and execution story. It is interesting around these levels, but not an automatic buy. I would want to see margin stabilization, continued free cash flow, and stronger evidence that the core checkout position is not weakening before getting too aggressive. If you want to follow these setups as the numbers change quarter by quarter, subscribe to Finance to Go. That is the point of this channel, finding the stocks where the story and the numbers are starting to diverge. Also, tell me in the comments, bull case or bear case, which side is stronger for PayPal right now. And again, this is educational content only, not financial advice. Always do your own research and make sure any stock fits your own strategy, risk tolerance, and time horizon. Thank you guys for watching. I'll see you in the next one.